Every year, your money quietly loses value. Not because you spent it, not because you made a bad decision, but because inflation is constantly working against you. A dollar today doesn't buy what it did 10 years ago, and it won't buy what it does now 10 years from today. This isn't a theory, it's a mathematical certainty backed by over a century of economic data. Yet here's the real question most people never ask. If inflation is guaranteed, why do some people still manage to grow wealth year after year, while others feel like they're running in place? The answer isn't luck. It isn't secret information. And it definitely isn't working harder. It's systems, simple, repeatable systems that quietly compound wealth while inflation eats away at everyone else's savings. Today, we're breaking down the exact systems wealth builders use to stay ahead of inflation, not speculation, not hype, but real strategies backed by historical data, economic research, and how money actually works. By the end of this video, you'll understand why inflation devastates some people and barely touches others, and more importantly, how to position yourself on the winning side. What inflation really does. To beat inflation, you first need to understand it clearly. Inflation is the gradual increase in prices over time. According to data from the U.S. Bureau of Labor Statistics, the average annual inflation rate in the United States over the last 100 years has been just over 3%. That might sound small, but over time it's devastating. At 3% inflation, prices double roughly every 24 years. That means if something costs $50,000 today, it could cost close to $100,000 in just over 2 decades. Your money loses half its purchasing power unless it grows faster than inflation. This is why holding cash long-term is one of the most dangerous financial positions. From 2000 to 2020 alone, the US dollar lost roughly 40% of its purchasing power, and during periods of higher inflation like the 1970s or the early 2020s, the erosion happens even faster. Wealth builders understand this fundamental truth. Saving money is not enough. Money must grow, or it falls behind. Ownership over storage, the first system wealthy individuals rely on, is simple but powerful. They prioritize ownership over storage. Most people store money. Wealth builders own assets. Cash stored in a bank account does not grow faster than inflation. Even high-yield savings accounts historically struggle to keep up. For most of modern history, real interest rates on savings accounts, meaning interest after inflation, have been close to zero or negative. By contrast, asset ownership changes the equation entirely. Take the U.S. stock market as an example. According to long-term data from NYU professor Aswath Damodaran and Standard & Poor's, the S&P 500 had returned roughly 10% annually before inflation and about 7% after inflation over the long run. That means investors who consistently own productive companies didn't just preserve purchasing power, they increased it. The same concept applies to real estate. Residential real estate in the U.S. has historically appreciated at around the rate of inflation, but when rental income is included, total returns often exceed inflation significantly. Property owners benefit from rising rents, tax advantages, and the ability to finance with long-term fixed-rate debt. Wealth builders don't wait for perfect timing. They focus on long-term ownership of productive assets that generate cash flow or grow in value. Ownership turns inflation into an ally rather than an enemy. Automated investing and forced discipline. The second system is automation. One of the biggest mistakes people make is relying on willpower when it comes to money. Wealth builders remove emotion from the equation. Automated investing, such as regular contributions to retirement accounts or brokerage portfolios, has been proven to dramatically increase long-term returns. Studies from Vanguard and Fidelity consistently show that investors who automate contributions outperform those who try to time the market. Why? Because automation enforces consistency. When markets fall, automated investors keep buying, often at lower prices. When markets rise, they continue investing without hesitation. This creates a powerful form of dollar cost averaging that smooths volatility over time. Data from Fidelity shows that some of the best performing retirement accounts belong to people who forgot they even had them. Not because they were smarter, but because they didn't interfere. Wealth builders understand that inflation doesn't care about emotions. Their systems don't rely on motivation, they rely on structure. Income that adjusts with inflation. One of the most overlooked aspects of inflation protection is income. Most people focus only on growing investments, But wealth builders also focus on building income streams that adjust upward as prices rise. Historically, wages do increase over time but often lag behind inflation, especially for workers without bargaining power or specialized skills. This is why wealth builders prioritize income sources with pricing flexibility. Business owners can raise prices. Professionals with scarce skills can negotiate higher compensation. Investors in dividend-growing stocks benefit as companies increase payouts over time. According to research from S&P Dow Jones Indices, dividend-paying companies have historically outperformed non-dividend payers over long periods, largely because dividends tend to grow faster than inflation. Rental real estate offers another example. Lease renewals allow landlords to adjust rents to reflect higher costs of living, providing a natural inflation hedge. Wealth builders don't rely on fixed income alone. They build income streams that can expand alongside rising prices. Strategic use of debt. This might sound counterintuitive, but one of the most powerful inflation systems used by wealth builders is responsible debt. Inflation reduces the real value of fixed-rate debt over time. When inflation rises, the future dollars used to repay loans are worth less than the dollars originally borrowed. This is why long-term fixed-rate mortgages have been one of the greatest wealth-building tools in history. If you borrow at a fixed interest rate and inflation averages higher than that rate, inflation works in your favor. Meanwhile, the asset purchase, such as real estate, often rises in value alongside inflation. This doesn't mean reckless borrowing. Wealth builders use debt strategically, backed by cash flowing or appreciating assets. History shows that during periods of moderate inflation, asset-backed borrowers often benefit, while savers lose purchasing power. Debt is a tool. Used improperly, it destroys wealth. Used strategically, it accelerates it. Tax efficiency as inflation defense. Inflation isn't the only force eroding wealth. Taxes play a massive role. Wealth builders understand that it's not just about how much you make. It's about how much you keep after inflation and taxes. Tax-advantaged accounts like 401ks, IRAs, and Roth IRAs allow investments to grow with either deferred or tax-free treatment. Over decades, this dramatically increases real returns. According to IRS data and long-term projections, tax-deferred growth can result in hundreds of thousands of additional dollars over a working lifetime compared to taxable investing alone. Real estate investors benefit from depreciation, which can shelter income from taxes while assets appreciate. Business owners use legal deductions and incentives built into the tax code to reinvest capital efficiently. Wealth builders don't evade taxes. They understand them and design systems around them. Long-term thinking and time arbitrage. Perhaps the most underrated system of all is time. Inflation punishes short-term thinking and rewards patience. Short-term speculation exposes people to volatility, poor timing, and emotional decision-making. Long-term ownership allows compounding to overpower inflation. Albert Einstein famously referred to compound interest as the eighth wonder of the world. While the quote's attribution is debated, the math behind it is not. At a 7% real return, money doubles roughly every 10 years. Over 30 years, it increases 8-fold. Over 40 years, it increases 16-fold. This is why wealth builders think in decades, not months. They don't ask, what will inflation do next year? They ask, what systems will still work over the next 30 years? Time is the most powerful inflation hedge ever created. Why simplicity wins? One of the biggest myths about wealth is that it requires complexity. In reality, complexity often benefits institutions, not individuals. The most successful inflation-resistant strategies are simple, boring, and repeatable. Own productive assets, automate investing, build adaptable income, use debt carefully, minimize taxes legally, let time do the heavy lifting. These systems are not exclusive to the wealthy. They are available to anyone who understands them and applies them consistently. The difference isn't access, it's execution. Inflation is guaranteed. Losing to it is optional. The people who stay ahead aren't smarter, they aren't luckier. They don't predict the future better than anyone else. They build systems that work quietly, consistently, and relentlessly over time. If this video helped you see money differently, imagine what a full library of clear, honest financial education could do for you. Subscribe to the channel so you don't miss future videos breaking down how wealth is actually built in the real world. Like the video if you found value in it. It helps more people discover this content. And stay connected. Because the more you understand these systems, the harder it becomes for inflation to steal your future. Your money should be working as hard as you do.